Okay, sir. Good evening to all. This is Vishwas, digital marketing expert from RERA Consultants LLP. I welcome you all today's webinar on GST series for real estate. Today's topic is GST applicability in area sharing, mixed and commercial projects. I am honored to welcome our speakers for the day, CA Venugopal sir, CA Rajesh sir, and Ashika madam. Let me start by introducing our first speaker for the day, CA Venugopal sir. He is a founder partner in Venu and Vinay Chartered Account in since 2002 with academic credentials, which include securing All India 45th rank in CA final. He is also certified information system auditor. He has completed various other certification courses from ICI, namely DISM, course on business valuation, course on internal audit, course on fraud detection, forensic accounting. He has completed a one-year course from IIM on data analysis and business intelligence. He has authored various industry-specific handbooks on GST. He has contributed to the technical guide on GST audit released by ICI other publications materials. He has developed a lot of Excel-based free utilities on GSTs like JSON Reader, creating JSON files, GST Invalidator, composition versus regular benefit analysis, GST Impact Reader, real estate project switch decision analysis, GST Audit, working paper tool, and many more. He is GST faculty for ICI and conducted various workshops and webinars. Apart from audits, his other areas of practice includes coding, hands-on coding, Visual Basics, .NET, Python. He also reviews database design. He conducted various workshops for corporates on use of technologies, improve efficiency at work using Excels, building automated reports from accounting and financial applications. He is the man behind the development and managing of cloud applications like TaxSmile, Insta Financials, and others. Now, it's time to introduce our second speaker for the day, CA Rajesh sir, who is one of the top chartered accounts in practice and partner at Venu and Vinay Chartered Accounts and proprietor of RKTR and Co. He is practicing in the field of indirect taxes at Bengaluru for more than 20 years and advising clients on compliances, tax planning, and representation to government and authorities. He has authored number of books on GST, central excise, service tax, KVAT as author, joint author, as well as assisting author. To name some of the books, handbooks on annual returns and GST audit, GST Ready Reckoner, GST Tariff, Practical Guide to the Service Tax, Central Excise Made Simple, Central Excise Law and Procedures, and KVAT Audit Manual. He has also contributed for background material on GST and UAE VAT published by ICAI. He has been training the professionals, students, industry, and departmental authorities in the field of indirect taxes on invitations from ICI, ICSI, NACIN, Tax Department of State and Central, educational institutions, trade bodies, professional bodies, and many more. Written many articles on central excise, service tax, VAT, and GST for various professionals journals. Now, I am honored to introduce our third speaker for the day, CA Ashika madam. She is currently holding the position of Senior Manager GST at Venu and Vinay Chartered Accounts. Having achieved Chartered Accountancy in 2013, she has decided her professional journey to the intercient realm of indirect taxation. She has comprehensive exposure to the GST ranging from examination of taxability, compliances verification, educations, and appeal representations at all levels. In addition, she has been an active participant, actively contributing her insight to various discussions and topics surrounding GST. Today, from these experts, let us learn more about landowner liability on development rights, builder liability on OC dates, reversible of common credit, live demo with practical examples. Now, I request Rajesh sir and Ashika madam to take over from here.
I think Venu is also there. Venu will just give a brief introduction if he's there, and then probably we will take over later.
Yes.
Venu, are there?
Yeah.
Venu sir?
Yes, sir.
Welcome,
Yes, sir.
sir. Welcome, sir.
Yeah. So very happy, and firstly, special thanks to RERA Consultants LLP to host these knowledge sessions month over month, and Opaza and Naredco, the hosting partner. Friends, we've been doing from last 2 years the monthly webinar on various aspects of the real estate. And I'm sure those who have attended the last series, we've started on the looking at the practical aspects of it. We looked at the development activity in an area sharing. We have looked at revenue sharing. Today, Ashika would be walking us through the various aspects of the mixed project. And it's been quite common that every real estate project has an element of the commercial, either front facing or different facets of it. And with 1st April 2019, where the law has changed, where residential is purely 5% without any input tax credit, and whenever we say 5%, it is 7.5 with 1/3 land deduction. And the commercial is with input tax credit, especially when the projects are mixed projects. And last session, we also discussed that an RREP project where the commercial is up to 15%. Thankfully, law has recognized that commercial deemed as a residential, even that is 5%. So taxation is pretty simple and straightforward. Of course, the complicated part was the development rights, and in over various sessions, we have discussed it. And I would request Rajesh sir also to share at the end the recent updates on the development right, the Pragati construction from Telangana High Court to Supreme Court. And those who have any cases that have come up on any of the historical contracts which is started prior to July 17 or between July 17 to 25th Jan 2018, or between till April 19 and transited to the subsequent phases. There would be very peculiar situations where the liability sometimes was forward charged to the landowner and sometimes to the reverse charge to the developer. And I'm very happy that Rajesh sir, the legal expert in the real estate domain who represented before the tribunal and assisted in high court matters amongst us, who can give us the practical side of the legal interpretations of the court. What is very important, friends, is to practically get a hold on the concept of the subject. And as Ashika would be walking us through the various permutations and combinations, request everyone to make note of the method of which the computation is. And feel free to put your questions, and we will assist in answering as much as possible within the session. And reach out to us even after the session on any of the practical aspects about consulting on any of the actual JDA engagements or the way it is drafted. One other last point before I conclude. Generally, we all know joint development agreement, there are two parties and entering a transaction, landowner and developer. The taxation is not going to be the same in all aspects. Now, why do I say that? What matters is how the contracts have been drafted. GST is purely dependent on how in the contract the position of the developer is and the position of the landowner is, and how it has been worded, whether the right to collect, whether he is a subcontractor, all those also do matter. So looking at a joint development agreement and giving an answer is always the right thing, because substantially everyone thinks that it is a joint development agreement and everything would be the same. Sometimes there is an area sharing, revenue sharing, and mixed also. So all these aspects also to be considered. And with these opening notes, I would request Ashika to start the session and request Rajesh sir to interrupt as and when he thinks if some more points to be added to the participants. Over to you, sir.
Thank you, Venu. And I think also I should tell the members that Venu is presently not in country, but still the commitment of his has we appreciated that he landed in outside country and still he wanted to participate in this and has joined. Thank you, Venu, for that. I think Ashika, you can just start the presentation. With your presentation, we'll go through the discussion, and if whenever and whichever the point I want to interfere and add my points, I will do that. Okay. Over to
Yes.
Ashika.
I hope so screen is visible. Is
Yes,
screen
ma'am.
is
Yes, ma'am. Yes, ma'am.
okay. Fine. So our today discussion will be on mixed project. Now, you would may think that why we need to discuss mixed project, and over here we will be discussing about area sharing. Why there is a need to separately discuss the same? Because in our earlier two sessions, we have already discussed about area sharing and revenue sharing, but we have discussed on RREP project, where the commercial property is less than 15%. Now, over here, the need for discussion has arisen due to the fact that in case of residential real estate project, even though you have a commercial part in it, it should be less than 15%, then only it will qualify as RREP. There is an effective GST rate of 5% and no ITC is eligible. But when we comes to the real estate project, mixed project, where residential and commercial both are there, and commercial is above 15%. When I'm saying above 15%, I'm talking about the carpet area. In the law, the way they have distinguished is based on carpet area, not on built up, super built up. You can't take on your basis the area to determine whether it is RREP or REP. It is only on the basis of carpet area, which will determine whether it will fall as a residential real estate project or a real estate project. Now, when we comes to a real estate project, over there, residential is treated separately and commercial is treated separately. Residential again come with the fact like RREP 5% without ITC. But commercials comes with the GST at the rate of 12% with ITC. Now, when I am saying 5 and 12, I am saying about effective GST rate after considering the land deduction. That is 1/3. So residential is 5 without ITC. That is one part. Commercial is 12% with ITC. Due to this change, it is important to understand how the GST will work under mixed project. It will not be the similar the way it worked for residential real estate project in area sharing. Now moving forward, we will be basically covering our session in this part. What is developer liability under the mixed project and what will be the landowner liability plus practical example. Now practical example, I will take side by side with the liability I am discussing. Now, the transaction which are involved in mixed project is similar to what is involved in area sharing. Only the pattern of valuation and ITC part is what to be taken care. The way it has been discussed in the earlier sessions of area sharing, first leg is where there is a transfer of development right from landowner to developer. Then there is a providing of construction service by a developer to a landowner, which we legally tell as barter, where landowner is giving a right to enter the property and in exchange of which the part of the land which developer is going to get, he is giving construction service to the landowner. That is the first two leg of JDA transaction. Now, the third leg is sales to the end customer, which can be by landowner to end customer and developer to end customer. With this, we will move toward how the taxation on development right will work under GST. We have in development right part, where there is a landowner is allowing a developer to enter the premises. As we know, with land, multiple rights come. He has the right to lease. He has right to allow another person to enter the premises. Like over here, he is allowing another person to enter the land and do the development. That is what the right we are talking about, the taxability. I will not go into the part of litigation on the development rights. We will keep it limited to the legal provision which is prescribed under GST. So when landowner is transferring a development right to developer, like it happened in residential real estate project, similarly, there will be tax will be determined on this transfer. How you will value it? The valuation which has been provided for transfer of this development right is the value of similar apartment which is given to independent buyer nearest to the date of JDA. More or less, we assume the first sale agreement which happened nearest to the JDA as our value, as our rate per square feet we identify, and based on that, what been the landowner part, landowner allocation has been in area sharing, to that we multiply and we get our value for development right based on the nearest sale, which more or less we assume the first sale agreement. On that, we get our development value. What is the GST rate applicable? Straightforward 18%. At the rate of 18% on such development value, you are liable to pay tax. Now, when I am talking about development right valuation, there is no difference between how it to be computed for the part of residential or commercial. In both the case, where is a mixed project, the allocation which has been made to landowner, either residential or commercial, it will be value at the same way it is value for residential. Only the difference will be based on sale agreement, what is the rate you have entered for residential, what is the rate for commercial. Different rate for residential and commercial will just determine the value. But mechanism of calculating the value of development right will be same. Just for example, as I said, side by side we will be doing. So this is our area detail. Now over here, I have taken total carpet area to be 1 lakh. Out of which I am saying there is a sharing between landowner and developer based on 35 and 65%. Now out of this is area allocation, 35 is to 65. Out of this, we are saying residential portion is 60, commercial is 40. As commercial is 40%, therefore it is RREP, mixed project. So out of 1 lakh, 60 belongs to residential, 40 belongs to commercial. Landowner is 35 and developer is 65,000. Now coming to development right valuation. Like I said, now over here, out of 35, landowner has 21,000 as a residential portion and 14,000 as a commercial portion. It's important that this fact is clear, because on this fact only, I will determine taxability at each and every head where developer is liable and where landowner is liable. I hope so this is clear. 1 lakh is total carpet area, out of which 60% is residential, 40 commercial. And the sharing which is happening between landowner and developer is 35 is to 65. Now, when we comes to the valuation part, like we discuss over here. So over here, residential is 21, which is of landowner, 14,000 of commercial, which is also landowner. Now rate as per JDA. Now I am assuming nearest sale to the JDA has a rate per square feet of 5K. And for commercial, it has 6,500. Now how I will determine the value? Now value of development right will be 21,000, which is a landowner allocation, into 5,000, which is the residential rate at that time. That will be the value of development. Similarly, for commercial also, landowner allocation is 14,000 and the rate which is prevailing at the time of JDA is 6,500, assuming. So this is my value, 9 crore 10 lakh. So over here, we determine what will be my value of development right based on what has been provided under law. Now, in this, as of now, let us say there is no refundable security deposit as of now. Now, on this 1050, now I am liable to pay GST at the rate of 18%. So this is what the law is saying. You are liable to pay GST at the rate of 18% on the development. So over here, if you will see, there is no difference has come in residential part and commercial part allocation, which has been made to landowner. But as we know, there is one exemption which is given for the residential purpose for the development right. But it is important to understand first, this exemption is not straightforward exemption. On development right, promoter is liable to pay tax under RCM. So landowner has no liability to pay. If tax is not paid, department is going to recover it from the developer only, developer or promoter. So they will only collect the GST from the promoter only under RCM. But there is one exemption provided. What exemption has been provided on development right? If there has been, you have to check how much has been sold before OC or after OC, because exemption is limited to the extent of units which has been sold before OC. If there is any unit which has not been sold before OC, then that exemption will be restricted to that extent. One thing. Second thing, exemption is eligible only for resident. First, it is limited to the sole unit before OC. Second, it is eligible only for residential part. So if you will notice in my Excel sheet, I have done residential and commercial separately. Reason being, as I discussed, for commercial, this exemption is not eligible. It is only for residential that you have to take care of it. So only for residential part on development right, you will be eligible, and only to the extent of sold unit. On unsold part, this exemption is not eligible and you have to calculate your tax. Now, how this exemption work? This exemptions comes with one more maximum limit. It says whatever the GST payable you determine on development right based on the unsold unit, it should be limited to the value of that unsold unit. And to what extent of 5%. So to the extent of 5% of the value of unsold unit, it will be limited. In other way, if I say, it will be lower of or minimum of either 5% of the value of unsold unit or GST payable of the unsold unit on development right. Lower of this two will be considered. Now coming back to our example. Now over here, we got our GST payable under residential 1 crore 89 and under commercial 1 crore 63. As I discussed, this development right exemption does not operate on commercial. Therefore, on development right, I am liable to pay GST of 1 crore 6380. There will be no exemption, nothing. Straightforward, I have to pay this tax in cash by the developer. But when I come to the part of residential, over there, limits operate, exemptions comes into picture. Though prima facie 1 crore 89 is the tax which is payable on that development right, but due to this exemption, I have to consider minimum on the basis of unsold unit. Now, first part is development right of unsold unit. Now, over here, when I am taking my tax which is payable on development right is 1 crore 89. But my unsold unit over here, my unsold unit in this data, I have also put unsold unit as on the date of OC. Now, my developer unsold unit as on the date of OC is 3,900. Now, you will say, if you will see in this formula, I haven't taken the landowner unsold unit. Reason being, what belongs to landowner, it cannot be sold by the developer. It has already been allocated. It has already been given to landowner. Therefore, it is not an unsold unit. So only the unsold unit which belongs to the developer, that is also of residential. Over here, if you will see in example, commercial is also there, unsold unit. But as I said, on commercial, you are liable to pay what has been determined based on the value. There is no exemption which restricted to unsold unit. So I am liable to pay on full value. But when it comes to the residential part, this exemption need to be taken care based on unsold unit. Now over here, 3,900 is my unsold unit. So GST payable, which is 1 crore 89 into unsold unit divided by total carpet area of residential. So 60 is my total carpet area of residential. See, I am not dividing it by 1 lakh. It will be only by 60. That is residential related because this exemption is only for residential. So 1 crore 89 GST payable into unsold unit divided by total carpet area of the residential. This is what they are saying me option 1 to calculate. Option 2 means bar, which they have given that it can't cross. This tax cannot cross this value, which is 5% of unsold unit into means 5% of the value of unsold unit. Now for determining the value of unsold unit, because as it is unsold unit, we can't know what will be the value. So they say what is the latest sale or nearest to the OC date. Assume that as a rate. Now over here, I have assumed that nearest sale which has happened at the OC time, it's 6K. And I am multiplying 3,900 square feet into 6,000 and into 5%, which is the upper limit they have given. It will all determine based on whether it is affordable housing or non-affordable. In this example, I have assumed non-affordable. That's why 5%. If it is affordable, then it is 1%. So lower of this two will apply, that is 1170. And thereby, my tax payable for development right will be 1170 under residential and 1 crore 60 under commercial, making my total development right tax which need to be paid is 1 crore 75 lakh 50,000. I hope so till this it is clear. And one more thing, if you will see, when I am calculating my development right value, I have taken rate nearest to the JDA date. But when I calculated the unsold value as on date of OC, for this purpose, I have taken rate which is nearest to the OC date. So this is for development right, how it to be calculated in the case of mixed project. Because over here, what people misinterpret is while doing calculation, GST payable on TDR, they determine the value into the rate per square feet, then determine the GST rate. Okay, this is what is coming. But over here, even though they take unsold unit of residential area, but while taking total, they take total instead of excluding commercial part. So over here, care to be taken that only residential related portion should be divided, should be denominator, not the total carpet area. Sir, you want to add something?
Can you just repeat what you mentioned? What should be numerator, what should be denominator?
While considering the numerator, unsold unit or unsold carpet area of the developer need to be taken, and that also of residential. So what need to be taken is first unsold. Second, it should be of only developer. Third, it should be only in relation to residential because this exemption relate to residential. This should be your numerator while considering. While considering denominator, when we comes to denominator, though the word is used total carpet area, but it is saying total carpet area of residential portion. It doesn't mean total carpet area of the project. Like in our example, if we see our total carpet area is 1 lakh, but residential is 60. So to the extent of 60 will be only our denominator, not 1 lakh.
This GST payable on TDR is total or only residential area? Next question.
The residential separately and commercial separately.
Effectively, this working itself is everything related to residential. So we are not taking a carpet area of the commercial. That's what is the point.
Yes.
Yeah. No, that's what I wanted them to highlight. Okay. Proceed, please. Okay. Before proceeding, I want to just give you a little background of this particular concept of GST payable on this transferable transfer of development right, TDR. Basically, when this concept of this 5% scheme was coined out, the government was clear in their mind that they want to collect tax on each and every flat which is done by the developer. Whatever the flat is constructed by the developer, to the extent he gives to the landowner, he will pay tax on a forward charge, no issue. To the extent of the flats belonging to the developer, which is sold or booked prior to completion certificate, he is going to collect and pay GST. What was the area? I mean, what was the extent of the amount which was being not taxed? Was effectively the flats remaining unsold or unbooked, which he is going to sell after completion certificate, is not going to pay any GST. So government wanted to tax that portion. So effectively, they coined this concept of development right and said you have to pay tax on that under RCM to and coin this concept of development right and effectively making it tax only to the extent of the unsold. So in a overall, developer will end up paying tax on the entire 100 flats which he has constructed, either forward charge to the all the flats given to the landowner, or to the extent book POC anyhow is going to pay for the customers, and for the remaining under RCM. There also the mechanism what they have computed is that take a first sale value and compute a TDR value without land deduction and at 18%. But however, they've capped the tax to be paid to the 5%. I'm repeating, please understand. Computing TDR is one part, but finally it is capped to the payable of the at the time of CC. What is the selling price, prevailing selling price on the flats remaining unsold into 5%? There's a cap they have put. So he need not pay tax beyond 5%. Effectively, if he had sold that flat to somebody, he would have paid that 5%. So this is for the residential portion. This is clear. But as for the commercial, they have said, no, they have to pay tax. This exemption is not available for commercial because he will pay under RCM. And further, if he's selling the flat, commercial, whatever the plots or commercial portion of the building, he's anyhow going to charge GST. So he will take a ITC to the extent if he's selling after the OC, he's anyhow reversing the credit proportionate to that. So government will get that revenue. So government is very clear that in the entire scheme of this TDR which they have brought in, they want to ensure that no portion of the developer's income effectively gets, escape the tax liability. This is a theme or the concept with which is this designed. If you understand the concept and then read this notification, it will be easier for you to get into that particular concept. Though when Ashika was explaining, you might have think, what is this development right? Again, computing TDR and again capping. You better, if you know this concept, it will be easier for us to understand this notification. Otherwise, we will be lost completely. Already once we have paid on the landowner's portion of the building you have given, again you are telling that you have to pay under RCM. What is it? So I think with this example, you would have got what is the purpose and intention of this entire scheme of taxation on the development side. Ashika, you can go ahead, please.
So if we summarize our taxability of development right under mixed project, So on residential portion, you are liable to pay under RCM, but to the extent of unsold. And no ITC is available of what payment has been made under RCM for residential portion. Coming to the commercial part, what you have to pay under RCM, irrespective of the fact how much unit is sold, how much is unsold. But over here, you would be eligible for ITC, which of the tax which has been paid under RCM. So on commercial portion, what tax you have paid under RCM on development right will be eligible as ITC. But as Sir said, it will be limited to the extent of the sale which has been made before OC. Because which has been sale made before OC, on that only you will be paying GST. And the sale which is made after GST is considered as sale of immovable property, which is covered under Schedule 3. So specifically excluded from GST. As you are not paying tax, so the government is also restricting the ITC to that extent. Now we are coming to the part of our taxation of supply of construction service. We learn about the transfer of development right from landowner to developer. Now we are coming to the part of construction service provided by a developer to a landowner. Now, on construction service provided to a developer to a landowner, as it is a barter system. Over here also, GST is applicable. How it to be valued is, again, the value which is nearest to the, it will be same value of similar apartment nearest to the date of development right. So when the transfer of development right has happened, which is to the date of JD, the similar way, similar rates which has been adopted for development will also be adopted for construction service. As it is a barter, so value happen to be at the same amount. So same value will be considered based on similar apartment which is sell to the independent buyer. Now, you need to notice, even when we were discussing about development right valuation, even when we are discussing about construction service to landowner, every time we are stretching on the fact similar apartment to independent buyer. So any related party transaction, if done, because there may be a chance that sale has been shown as a lower value in order to reduce the GST implication. To avoid such type, they have said sale which is made to independent buyer, that value you have to consider. At that rate, you have to determine about the services which are provided by landowner to
Hello, Ashika madam. Hello.
Ashika, we
Hello.
lost you. Hello.
Hi, sir. I think Ashika madam lost the signal, I think, sir.
1 minute. We'll just wait for a couple of minutes.
Yes.
I'll just try to reach out to her.
Dear participants.
And I think, yeah, Ashika joined back. Ashika, there was some technical difficulty.
connection.
Yeah, okay. Sure.
So over here, we will determine the value similarly like we have determined for development right. However, over here, we will be eligible for 1/3 deduction on account of land. So the value which will drive, we will do 1/3 abatement, and then we will calculate our GST liability on the same. So again, taking you to the sheet example. Now I am discussing side by side because when we are discussing a topic, it becomes easy to understand. So this is the same example. Same, this is the fact. 100% is my total 1 lakh is my total carpet area, 60/40 is the residential commercial, and 35:65 is landowner portion. Now coming to the part.
Are you presenting an Excel sheet or?
Yes, sir, I am presenting Excel sheet.
But actually, on the screen, it is not visible. Last time also, it was not visible. Now it is visible. Okay. Yeah, now it is clear.
So development right, should I repeat once again? So again, 1 lakh is the total carpet area, 60/40 is my residential commercial, and 35:65 is my landowner developer portion. Now 21,000 is my area which has been allocated to landowner of residential. Rate per square feet 5K I have assumed. My value of supply comes to 10.50 crore. Now I will be eligible for 1/3 abatement. Thereby, on 2/3 I am liable to pay tax, which comes around 7 crore, and GST at the rate of 7.5% comes to 1.26 crore. This is what the tax I am liable to pay on my residential portion. Similarly, I will do for commercial. Over here, landowner, I have done 14K as a allocation of commercial part. Rate per square feet, I have taken 6,500. My value of supply came to 9 crore 10 lakhs. Again, 1/3 abatement. And thereby my tax is coming 1 crore 9. But over here, one more thing you will find, which is not there in residential. In residential, it is tax without ITC. But when I comes to commercial, it is tax with ITC. So over here, I would be eligible for the ITC, and I can use it to set off against my liability, which need to be paid towards the landowner allocation. So that's the difference between REP and RREP. In REP, you will get this benefit, but in residential real estate project, you will not get any of this benefit. Now, how this is calculated, we will discuss subsequently, but this is the one difference which happened in mixed project. So this is for construction service to landowner. So you want to add something?
No, Ashika, you can proceed.
Now, about this ITC part. Now, over here, I have taken one example. Over here, I haven't divided into ICS. I have taken on a total basis. Now, as it is a mixed project, so therefore, to the extent of commercial part, I would be eligible to claim the ITC. Now, how it to be worked out, how it to be calculated. Obviously, my total project will be having some cost. On that cost, I would have paid the taxes to my supplier. Over here, I am assuming based on that cost, 3 crore ITC has come to my account, which is reflecting in all the compliance of ITC has been done. We are over here not discussing about ITC, eligibility and all, limiting it to, suppose I am eligible for 3 crore ITC. Whatever tax you have paid under RCM, that also will be eligible for ITC. But it to be kept in mind, tax payable under RCM, when I said it's only 9.3, notification 13. The services which are specifically covered under RCM. The tax which is paid under RCM on development right, you can't take credit over here. It is other than development right. Mandatory RCM like legal services, GT, whichever tax you have paid under RCM for those services, that you can claim ITC. But not in total to the extent of commercial. As of now, how much the total is coming and how we are driving, we are writing. Now, for the development right on commercial, as we discussed, when we were discussing about residential, ITC is not eligible. But when it comes to the commercial part, over here, the commercial, what tax I have paid under RCM, I'm eligible to claim the same. Accordingly, what I have paid on TDR, development right, I'm eligible to claim, but only to the extent of commercial. That's why while working, I have done residential and commercial separately. because separate reason for considering is 1170 will not be allowed. Only 1,63 is what I can take ITC, which is what also discussed by Sir previously. So total coming to 4,65. Now over here, if you will see the total ITC which is there, I have divided into two parts. One which I am saying common to residential, and one which I am saying only commercial. Now there is a reason why. Now which is residential and commercial, that is ITC under forward charge which is appearing plus RCM which you have paid. This 302, it is common to both. How much construction has been done for the project of residential and commercial, it is common to both. But when you see 163, it is specific. It has been specifically paid on commercial project which you are eligible. This is on residential, so to the extent of residential, it will be disallowed. Now, then you will calculate your exempted area. Now, while calculating exempted area, if you will see, one part of exempted area will be your 60% of the total project, because 60% of the project is residential. So to the extent of residential, you are not eligible to claim the ITC. And to the extent of commercial, you are eligible. But with this, I have added one more component. What is that? Is unsold unit. Now, which is developer unsold unit as on the date of OC, as they won't be paying tax on the same after sale of after OC sale. That also will form part of your exempted area. So total area is 1 lakh. While considering exempted area, you have to consider developer unsold area plus residential portion. Accordingly, when we put on the part of common ITC of residential and commercial, which is 3 crore 2, so it will be multiplied into 66 divided by 1 lakh. Unsold plus residential divided by total carpet area into common ITC for residential and commercial. So this is what I need to reverse the ITC, and balance is what I am eligible. Now second part of it, which only belongs to commercial, that is the tax which is paid on TDR for commercial portion. Now over here also, I am doing the fact of unsold unit also impact, because though my 40,000 is a commercial portion, I am eligible for ITC of it, but 2,600 which is developer unsold unit, and when they will be selling, they won't be selling with GST. Therefore, this 1,63.
Hello. Ashika,
Nice.
I see. Like
Yeah.
the voice
You
is
can
not
just
that
repeat
much clear.
the last couple of minutes. Can you just repeat, because we lost your meeting. Ashika, we are not able to hear you.
Yes, sir.
Okay, now we are able to hear you. Sorry.
Okay. So I am saying this is my total ITC available, which is based on what is I have paid toward the cost of project. Over there, what I have paid taxes to my supplier, that amount, what I have paid under RCM, but mandatory RCM means legal fee, GTA, notification 13, plus the tax which I have paid under RCM for commercial portion of development right. That also will form part of ITC, making it total to 4,65. Now this ITC I have divided into two. One is residential plus commercial, one is only commercial. So residential plus commercial, I am taking FCM and RCM, but the tax which is paid on the development right of commercial portion, I am taking separately for commercial. Because as we discussed, whatever tax I have paid under RCM for development right of commercial will be eligible as ITC. So prima facie, I don't need to form the part of computation while considering the total carpet area, because this solely belongs to commercial portion, 40%, on which I am liable to pay tax until there has been unsold unit before OC. So now I am calculating what should be my exempted area for the purpose of residential and commercial calculation. So residential portion, as we have taken in our example, 60 to 40, 60% we are saying it to be residential. So that become a part of my exempted because with no ITC is there. Plus, I will also add unsold unit. I have to add only unsold unit of the developer. Reason being, on that developer is not paying tax. For landowner, unsold unit will not form part of it, which we have already discussed from, because this working is been done from the point of view of the developer. When we are doing from the point of view of the developer, landowner unsold unit is not developer unsold unit, because developer has already paid the tax on whole of the amount of landowner allocation. So only the developer unsold unit will form part of exempted area. Now my total area is 1 lakh as per our example. So what common ITC of residential and commercial I have tried, I will multiply it with exempted area as we calculated by total area. So to the extent of this exempted area of 2 crore, I am liable to not claim the ITC. I have to reverse it. Now coming to the part of TDR of commercial portion. For that also, I won't be eligible for 100% ITC. Reason being, though my 40K, I'm liable to pay tax, but due to unsold unit there, 2,600 is an unsold unit. So on that, I won't be paying the tax because it is after OC. To the extent of unsold unit, I have to reverse it, thereby making my total ITC eligibility out of 4 crore 65 to 2 crore 54. Because ITC eligibility is directly linked to the taxable supply with the condition to avail the ITC. As in case of residential, ITC is not allowed. Therefore, out of 3 crore 2, you will notice I have disallowed the residential portion and plus unsold unit. As on commercial portion, ITC is allowed, but due to the fact that there has been an unsold unit, on that I am not going to pay GST. So to the extent of unsold unit, I am reversing the ITC and balance is what I am claiming. Now this is what I have claimed. I can adjust against my liability, which I am liable to pay toward landowner allocation. I can adjust this ITC toward my liability. It's not the case I have to adjust with landowner portion only. Even what the sale I am going to make to end consumer, I can adjust it. Because the date when I am determining my landowner liability, that is on development right or construction service, at that time, I won't be having any ITC. Means it's the initiation of the project. So we might be having cost and all, but accumulation would not have happened of the ITC. So care need to be taken while determining the liability and ITC adjustment. Because in mixed project, due to commercial coming into picture with higher rate with ITC eligibility, the way of determining the GST liability get little change the way it work in residential real estate.
Okay. I think further to what Ashika explained of this computation in Excel, etc. Also, one more important matter which has to be kept in mind is which part of the return we need to disclose, where we are to disclose, in which column, and how to disclose. Also, a matter of thing. Probably we will address that separately in a separate session, giving where which in the real estate sector, how to fill the returns, in which all the column, what all the value should come, and also how to reconcile to the financials. Probably we'll take separate independent session, and that will be more important for us to also know. Okay. You can proceed, Ashika.
Now, over here, we have discussed about the fact how developer is how the transaction between developer and landowner is liable to tax. And we have seen on landowner portion, it is only the developer who is liable to pay tax by way of development right and construction service, which is provided to landowner. Now, moving forward to supply to end customer. Now, first part which we are discussing about supply to end customer, we are discussing from the point of view of landowner. Now, when the landowner is further supplying, he is also liable to pay GST on the same at the rate of 5 or 12, whichever may be the case, means residential or commercial. Effective GST rate of 5% or 12%, he is also liable to pay. But he is only liable to pay if sale is made before OC. If, like developer case, if he also makes sale after OC, no GST is payable by landowner on the further supply of flats or commercial property. With this, there is one more thing to be noted. When the landowner is making a supply before OC, tax benefit also been extended. So, what tax has been paid by a developer on account of construction service can be claimed as ITC by landowner. But it is to be kept in mind, ITC can be claimed only when tax is borne by the landowner. Like sir, in the initially before starting the session said, it's the term of the JDA which determines. So how your JDA is worded, it plays a very important role. It will determine not only the liability to what extent GST will be bear by landowner, plus also the ITC eligibility of the landowner. So simply put, if there is a sale before OC by landowner, then landowner is liable to pay GST, plus it can claim the ITC of tax paid on construction services between the transaction between the developer and landowner. Now, let us have one example and understand how the liability of landowner works. Same facts of the case, 60 and 40 is your residential and commercial portion, and for 35 and 65 is the allocation between landowner and developer. Now over here, like we can see, 21,000 is the square feet which has been allocated to landowner for residential purpose, out of which he has not sold 2,100 as on the date of OC. So over here, he has sold 18,900 square feet before OC. We have assumed 6K as the rate. And on this 18,900, landowner is liable to pay GST because it is a sale made before OC. The way the tax, construction service tax is determined, similarly, it will be determined over here based on the actual realization, how much amount he has saved, it will be determined. Over here, we have assumed based on some rate, 11 crore 34. Again, 1/3 deduction will also be available to landowner. On 2/3 taxable value, GST is payable. However, over here, if you will see the difference between landowner and developer, in case of developer, ITC is not available for residential. But when it comes to landowner, specifically it has been provided that landowner can avail the ITC. But the thing is that it can't avail 100% ITC. So above, if you will see, when we were discussing under construction service, in residential, when the developer has paid, he has paid on residential portion 1 crore 26 lakhs. He has paid 1 crore 26 lakh. But if you will see down over here, when I am considering the ITC benefit, I have given the benefit of only 1 crore 30. Though my developer has paid 1 crore 26, but as discussed, it is restricted to the sold part. So over here, only 18,900 has been sold out of 21,000. So proportionately to the extent of 18,900, ITC can be claimed by landowner. Balance he need to pay in cash. And you may ask also that I have utilized 1 crore 30, but I was having 1 crore 26. The differential ITC, which you are not able to utilize, that ITC will get lapse. You can't use anywhere or in any manner. That will get lapse. And one more important thing to be kept in mind, ITC only on the construction service part is available. Landowner can't claim any other ITC to set off against this liability. It's only to of the construction services. No any other ITC he can't add to reduce this net tax payable. Similarly, when we comes to commercial, similar way it will work. Over here, landowner has got 14,000, out of which he has sold out only for 12,600. Applying the rate, value came 8 crore 31. 1/3 abatement will be there, but GST at the rate of 18% will be applicable, because I am deducting first land value and then applying. That's why I have taken 18%. Or you can straightforward apply 12% without doing land deduction. So 99 is what the tax has come. Over here, residential 7.5, commercial it is 18. Again, what the tax I have paid on the construction service of the commercial portion by the developer, that again I can claim ITC, but again it will be restricted to the sold unit before OC, and accordingly net payable for landowner became 151, and total amount which is payable on OC date by landowner is 24,19,000 after considering the ITC benefit. So this is what the difference which comes between the residential and real estate project. But even in residential real estate project also, ITC is allowed to landowner subject to the condition that sale is made before OC. Any ITC which is left after adjusting will lapse. Sir, you want to add something?
Nothing. Actually, this concept of landowner, many a times there is a what happens is, in practice, the developer himself will collect the taxes from the buyers on behalf of the landowners and pays. And landowner thinks that since the developer has paid, there is no liability. Actually, in my understanding, my personal understanding, that practice is incorrect. The liability to register and pay tax is on the landowner, and merely by the fact that the developer has collected the tax from the customers and paid in his account, and only paid the basic value to the landowner, will not discharge the obligation of the landowner to pay tax to the government. So, you have to be very careful in that scenario whether the developer should do that, or whether the developer should give that money, including taxes, to the landowner to pay tax to the government. Point number one. Point number two, developer is supposed to charge GST on the landowner, and the landowner is supposed to take ITC and utilize that. This is to avoid the double taxation, because 5% scheme, if the credit is not given, already developer has paid tax to the landowner. But again, further, landowner is also a supplier in looking at it independently from his perspective. And one is the fact that the notification is designed in this manner also establishes a fact that there is a independent and separate liability on the landowner for the consideration received towards the landowner's portion from the customer. So we have to be careful and cautious. Generally, at least 50 to 60% of the cases, the landowners are mentioning little more. The landowners are not complying this portion of the provisions of the law. Ashka, you can proceed. Ashka, you there? Ashka, we're not able to hear you.
Hello, sir. Madam is there, sir.
Now coming to the part of supply to end customer by the builder. Now, as we discussed at the starting of our session, that sale of residential portion, on sale of residential portion, no ITC is eligible. Only on commercial portion, ITC is eligible. Plus, on commercial portion, only to the extent sale has been made before OC, to that extent only ITC can be availed. Like, unlike landowner, where even in case of residential sale, ITC has been allowed. Same is not applicable in the case of landowner. But GST rate abatement is same. Similarly, the way it works. Now let us understand this with an example and how the ITC plays the role. Now, over here, taking same facts of the case, that my total carpet area is 1 lakh and residential portion is 60% and commercial is 40. Landowner is 35:65. Now, over here, as we are discussing about the developer, if you will see, my residential area which has been allocated to developer is 39K. However, out of residential portion of 39K, he has only sold unsold. Applying the rate will be actually based on actual realization, how much the developer made. Now, suppose the area which has been sold by developer at this value, by doing the abatement of 1/3, effective of 5%, 2,52 is what the liability, GST liability is coming for residential part. However, like when we saw in the landowner part, when we were seeing the landowner, we were seeing ITC was eligible. But when we compare with developer, you will see no ITC is eligible. Therefore, no ITC benefit will be available for residential portion. And developer is liable to pay on GST rate without taking ITC 2,52. What's the GST came based on the realization made or sale made. Now coming to the part of commercial. Now in commercial, if you will notice, 26,000 allocation has been made to developer, out of which developer unsold portion is 2,600. So thereby sold portion became 23,400. A value which has been realized 15 crore. Taking again, abatement benefit is available to both residential and commercial, plus to developer and landowner both. GST over here, but it will be at the rate of, effective rate will be 12. Without abatement, it will be 18%. But if you will notice over here, ITC will be eligible. So on commercial part, what has been sold before OC, that can be adjusted through ITC and thereby net payable can be determined. Now over here, 1,45 I have determined on the basis is, over here I showed how I have got my eligible ITC. So first ITC eligible 2,54, out of which 1,09 I have adjusted toward landowner, and the balance is what I am adjusting toward commercial. It's upon you the manner you want to adjust your ITC, because once you are eligible for ITC, you can use the way you want to use, but subject to the condition that is unsold unit, like we discussed about ITC calculation, those steps you have to take care. Exempt residential portion, unsold unit, thereby determine your ITC which you are eligible to claim, and then you can adjust it. It's upon you toward the commercial, residential, how you want to adjust. Because when you are claim, because you have already disallowed the ITC of residential portion, but there is no restriction on how you want to utilize the ITC. So it's all upon you once you become eligible for it. Thereby, amount payable which is determined for residential and commercial portion of sold unit before OC became 2,92, which the developer is liable to discharge on sale made by him to the end consumer. So if we summarize the part, is developer is liable to pay on two instances. One is landowner allocation and one is end customer before OC, sale made to end customer. On landowner allocation, 2 times tax comes. One as by way of RCM on development right, and of construction service provided. So in landowner allocation, it is barter is what is happening. Though landowner is liable to pay on development right because that's the consideration he is receiving. But by way of RCM applicability, liability has been shifted to developer. Now, what he has received in exchange, the developer, that obviously he will sell to end customer. When he is selling to end customer, on that he has to discharge GST. But when it comes to landowner part, he is liable to pay tax on what he is going to sell to the end customer. Now, over here, I am discussing about liability to pay, means the person who is responsible or on whom law has casted that he is the person who has to pay the GST. Over here, we are not talking about collected, non-collected and all, whether it should be charged to landowner and all. It will all come through the agreements. Which sir is discussing every time that JD agreement plays a major role, how you have entered, how is the drafting. So this is all about the mixed project taxability and GST implication. Sir, over to you.
Thanks, Ashika. I think a very detailed discussion on various aspects, especially the figures. I really do not know. It was, I mean, many participants would have not got the numbers so easily, but conceptually, you have to understand. Unless you go and open out an Excel sheet and really work out on that, it may be not so easy for us to get that figures. Conceptually, try to understand what was being spoken about. Second, at the beginning, Venu did mention about the decision of Telangana High Court, which is now carried before the Supreme Court. The issue there, what was challenged in the writ petition, was whether the transfer of development right, which is being taxed under the notification, is it correct? Is it legally valid? The argument which was put across was like this. As a landowner, I am not actually giving away only some right in it. Finally, I am also going to give away the land itself. The so-called development rights is an incidental or ancillary right to the land itself. So what I am giving away is a land, and cannot be any tax on land or a sale of land or a transfer of a land. Hence, they separately taxing a minor right or a supplementary right or an incidental right or an ancillary right, whatever you may call it, to the main land is incorrect, improper, not valid. For this, the High Court examined various terms and conditions of the joint development agreement and came out and gave a proposition. The land transfer or a conveyance will happen subsequently after the terms of the development agreement is fulfilled. If in the intervening before, whereas at the time of entering into joint development agreement, there is something which is going from the landowner to the developer that is nothing but a right to develop, which is called as development right. And that taxing statute is carving out this aspect and taxing it. And such action of the legislature to tax not the land, but some element out of that land, which is independently a separate transaction of an actual sale of land, is permissible and it cannot be quashed. Now, that decision of Telangana High Court is challenged before the Supreme Court. As per the latest news, the challenge is admitted. It is not allowed or dismissed. Merely the petition is admitted and pending before the. I mean, they have issued a notice to the government to respond to that writ petition, the objections raised. And still, it's a long way to go. on this aspect. We'll have to wait and see how it is going to be. Whether the government will be taking even if the decision comes out to say that there's no liability, whether the government will keep quiet, will there be any changes or amendment in the legislature, whether the changes which they're going to bring out, will it be beyond the scope of constitution or within the scope of constitution? So all those things is still a long way to see. But as we have been, I mean, as Venu mentioned, or as Ashika in the beginning told and proceeded with, that we are not getting into legal aspect. We are trying to assume that it is taxable and giving all this computation. I think that is a better, safest view if somebody do not want to take up a litigation. But however, if somebody wants to really challenge, they can surely challenge on the grounds, various grounds. That is how it's happening, because law is still in a nascent stage. We do not know finally how it is going to take its shape, especially with lot of legal interpretations are being done by various experts across the country. Unlike earlier indirect taxes, in the GST regime, lot of advocates and chartered accountants are involved and uh, giving their own interpretation, making this law to develop on its own. So overall, I think still lot of water to flow on this subject, and still the law is yet to take shape. So till then, there will be a lot of issues, confusion, lack of clarity, and uncertainty for the taxpayers, for the consultants to suggest, at the same time, government also to act. Uh, I think with this, we can conclude the session for the day. Any questions and other things? I think, Vishwas, you can just open the floor for any questions to be taken so that we can address that.
Dear participants, have you any doubts?
So you can put on a chat box, or if you raise your hands, I think they will unmute and ask you to talk.
Yes, sir. Yes, sir. Anyone is anyone is having a doubt, you can clarify here itself only. Our Ashika madam, as well as Rajesh sir is there to clarify your doubt. You can put on in the chat box also. I think everyone. Hello.
Ma'am, excuse me.
Yes, sir. Yes, sir. Sir,
Ma'am, in case of open land, agriculture land, if the developer goes into JV, so there is no concerns of GST in the land, right?
No, no. Why are you saying so?
No,
These notifications are not relevant. Essentially, these notifications are relating to residential, apartment construction, because REP, commercial. But we are not discussed in this session about the plotted development. Plotted development or plotting of a land, including agricultural land, is a separate subject in itself. And there also the developer, to the extent of the development activity, if he is carrying out to the landowner, I do not see any exception or exemption given to them. But whereas for the sale by the landowner to the customers of the agricultural land, yes, there cannot be any land.
thank you.
thank you, sir.
Thank you.
Anybody else? I think there's somebody's thing is unmuted and speaking.
No, sir.
Okay, I think if it is there, you can conclude the session.
Yes, sir. Yes. Thank you, sir. Dear participants, I thank you for your active participants, and special thanks to our speakers for giving us their valuable time and insight on today's topics. Hope the session was informative and knowledgeable. If you have any queries, please do contact us. Thank you. Have a great evening.